Edward, thank you so much for joining us here at SuperReturn International. Tell me what NewVest are doing that you see as almost disrupting, if you like, this industry at the moment.
Well, we certainly hope to be. I mean, we love the industry and we think it's doing great, but I think we can definitely help its evolution to the next stage. So what we're doing at NewVest is really bringing for the first time a way to have passive investing in private markets. Similar to what Vanguard did, and we hope to one day perhaps be the Vanguard of private markets. And probably seen this week, we had big headlines around for the first time in public markets, there are more public securities held by passive instruments than by active instruments. And so we hope to be able to bring a solution to LPs that will allow them in a very simple way to buy private equity, to buy private debt, new niche areas such as impact investing, which is so important as well. So those are things that we're bringing as innovation to private markets that are ready for the first time.
And you're hoping this will be particularly helpful and useful during this period of dislocation that we're in at the moment as well?
I think this period of dislocation is an amazing opportunity. This is an amazing time to be investing in private markets. From a private equity perspective, valuations have come down. There are going to be some great opportunities to buy at more reasonable prices, better valuations. So the returns in this vintage year are going to be great. I mean, I don't want to get too geeky and academic, but we know that historically, in times where there's been dislocations in the market and in bear markets, the private equity have generated more of an alpha on a relative basis to the public markets. So this vintage year should be a terrific vintage year for private equity. On private debt as well. If you think of this environment, it's no great crystal ball here saying that it's going to be a rising interest rate environment. Private debt is predominantly almost entirely floating rate. This is going to be better returns of private debt than we've seen over the last decade, and that's been a very strong decade. So private debt has matured and is a very attractive asset class today as well. And again, I think this vintage year will be a particularly strong one. So I'm very excited about those sort of core areas of private equity and private debt. And emerging areas such as impact investing are very important for the returns that they can generate, but also for the impact that they can deliver from a more holistic perspective.
Impact's something you've particularly been interested in too.
Yes, impact's always been close to my heart, and I've seen many of the impact fund managers that are pure play impact, and many of the very large GP managers out there that have introduced impact strategies are all doing things which are very important to make the world a better place, whilst generating great returns to investors. But from an LP's perspective, it's sometimes challenging. Some of these are new strategies, it's new funds. How do you invest in a first-time fund? That's also constraint of many. And so I think if you could just invest in the index of all of those impact managers, that's a de-risked and lower cost way of truly allocating in a scalable manner dollars to that emerging sub-asset class of impact investing.
And what measures do you have in place to make sure that those impact funds are doing all that they say they're doing in terms of ESG and there's no greenwashing happening?
Well, it's always a risk, but we are by nature a passive allocator. So we're relying on the sort of other lead institutional investors that are backing these managers. We will end up being maybe 1 or 2% of their LP capital base. Maybe over time, we could be 10 or 15 or 20%. We'll always be a passive investor and allocator by nature. So we need to make sure that there is none of that. And obviously recent news and headlines, there have been some cases which are not positive. Thankfully not in the private market space, but actually in the public space. But I think our general approach is to say, you manager that are an impact investing manager, what do you set as the metrics? What we need to know is that you state the metrics, that you measure them, and that you transparently report them. Those are the three components that are sort of good enough for us. If you state what they are, and you measure them, and you report them, and you have institutional backing that has gone through their diligence process, and we need 5 institutional independent investors for it to qualify, that's good enough for us. We're a very easy LP. I love to say to GPs, we're the best LP. We're certainly the easiest. Over time, we could be one of your biggest too. But being able to support also those first-time managers, etc., in the case of like impact, in their first close and last close, and for managers across their platform, private equity and private debt and impact sleeves, that's something that makes us sort of an attractive LP for a lot of the GPs.
You talked about how good it's been for this industry for so long, how good the returns have been, and does that mean that this industry have been less willing to move towards new ideas and sort of be disrupted?
Perhaps. I think that there's been over the last 2 decades, there's definitely been lots of innovation. And I think perhaps sometimes the market has not been given enough credit for the innovation that it has adopted. everything from financial engineering, the emergence of secondary funds, co-investment funds, advisory versus management. There's been a lot of innovations happening. And underlying, managers today have adopted tremendously use of technology, digitization, other strategies. They always have to be cutting edge in every bit of innovation that's out there to be adopted to generate better returns. I think that what we're bringing, the idea of passive allocation, it's just a natural evolution. If you think in public markets, Vanguard started 40 years ago, and it took 20 years, and there's great quotes of people in the 80s talking about Vanguard as, this is not American. And look where we are today, with more than 50% of public securities being held by passive instruments. So I think it's a natural evolution that the time has come for this to be also in private markets. And it's not going to happen overnight, but I think over the next few years we'll see a lot more of that happening.
What do you hope to take away from this event and being amongst so many of your colleagues here in Berlin?
I get inspired by every one of these GP conversations I have. Each GP has their strategy and the opportunities that they see, and I love to believe in all of them. And I do believe in all of them. The net result of numbers is that some of them are going to be the top quartile, some of them have to be bottom quartile. The median returns of the industry have been phenomenal, as we talked before. What we deliver is the pooled return, the weighted average return, and the distribution of returns in private markets are such that there's the right tail, meaning that the average is way better than the median. So you talk about median, outperforming public markets. Certainly the weighted average to what we can deliver is going to be even better than the median returns. It's around the top quartile every vintage year. So I take away from here the inspiration about where they're going to be putting the money to work. And if I can invest in all of them, I get the most excitement out of that.
I hope it's a good time for you. Thanks so much for joining us here.
Thank
Good
you.
to talk to
Thank you so much.
Thank you.
Lovely.